Hello, this is Chuck Carnevale, and with this video I'm going to look at 15 of the most renowned premier blue chip dividend paying growth stocks on the planet to illustrate how overvalued these blue chip dividend aristocrats have become today. As I wrote in the article, valuation is critically important and will have a great effect on the rate of return and the amount of risk you take investing in stocks. And we've had a terrific bull market over the last 7 or 8 years, and that has generated some really extraordinary returns. But my goal here is that investors don't get complacent and understand just how overvalued the market has come, especially for the dividend growth investor. Now, I'm going to utilize the Fast Graphs Fundamentals Analyzer software tool to make my case. So before I get started, I'm going to start with Johnson & Johnson here, but I also want to give people some perspective on how to interpret the graphs as they're presented. So with Johnson & Johnson, I've got an orange valuation reference line drawn based on operating earnings. And you can look in the Fast Facts section and you'll see in the color-coded, the orange box will tell you what PE ratio the orange line is drawn. So that's a valuation reference across the line. I will also, in the green shaded area, illustrate what the growth rate of earnings have been over whatever time frame I'm covering. Next, I will add monthly closing stock prices to the equation to illustrate valuation. When the price is above the orange line, it indicates periods of overvaluation. With Johnson & Johnson, you can notice here how overvaluation over the next several years, and I'm not going to go to the recession, created a very poor rate of return for this AAA rated blue chip. But there's also periods of undervaluation, and I do want you to notice how that always corrects itself, but how price, as I do all these examples, really correlates with the company's valuation reference line. I will also be adding a second valuation reference line to the graph, which is simply a calculation of the average or normal PE ratio as another reference that the market has applied over the time frame being drawn. And in the blue box, it'll tell you what the multiple is. So in the case of what I have up here right now, the blue line on this graph is a PE ratio of 17.8. Since this is all about dividend growth stocks, I'm also going to be plotting dividends, and that's plotted by the white line on the graph. And you can see Johnson & Johnson has steadily increased their dividends over this whole time frame, going from 2001. But I will also be showing that the area below this white line represents the dividend payout ratio, or the portion of total earnings that the company pays out. And then I will also take this portion and stack it on top of the orange line so that you can see that there are the two components of return: capital appreciation, if any, created from the price moving from point A to B, and then additionally the dividends that are paid out to shareholders. And then finally, I'm going to be marking each of these with a transaction. I personally like to keep track of where I purchase stocks so that I can essentially evaluate my decisions as well as calculate my returns. So with this first example, Johnson & Johnson, the Great Recession gave me the opportunity to purchase this stock in April 2nd, 2009, when the PE ratio was 11.7. Up through today, that stock has earned about approximately 13.5%. 10,000 has grown to 24,000, but it's also paid another $3,900 in dividend income. And I'm also going to be from time to time adding this dividend yield as another valuation reference, because what you'll see here in the case of Johnson & Johnson, when I purchased the stock at this low valuation, the yield was somewhere between, around of approximately 3%. Currently, it's yielding 2.6 and is moderately overvalued, whether you're looking at the orange line or the blue line on the graph. With some of these examples, I'll also be showing operating cash flow as another metric that can be utilized to value these businesses. Valuation is a puzzle, and when you look at operating cash flow with Johnson & Johnson, you see a very similar picture. April of 2009 was a great time to buy it because the Great Recession gave us the opportunity to purchase it at an extremely low price to operating cash flow. And I'm going to extend this graph out a little bit because I also want to make another point that I talked about in the article. And I pointed out that all bull markets end with a bear market and all recessions end with a boom cycle. And the gray shaded areas on the graph illustrate the two most recent recessions we've had. And as you can see, the recessions are rather short-lived relative to the bear markets and the economic booms that we have following those recessions. And in the article, I also talked about earnings yield, or calculating earnings yield, by simply inverting the PE ratio and dividing earnings by the price instead of the price by the earnings. And on each of these, I'll be showing you the current earnings yield. My minimum threshold is 6%. Johnson & Johnson currently offers only a 5.5% yield, which indicates moderate overvaluation, which can be clearly seen by looking at it relative to its cash flow justified valuation. With my second example, I'm going to take a look at AA rated Colgate-Palmolive. And once again, you see that the Great Recession created an opportunity to buy this stock at a significant undervaluation level relative to historical norms. This is a good example of a company that the market likes to put a premium valuation on, as you'll see with many of these dividend stalwarts and aristocrats here. Again, a steadily rising dividend income. The total rate of return from owning this stock has been over 13%. But here's the point. Although I love that as an owner of the stock, I'm also very concerned about its current valuation. When I look at the current earnings yield of Colgate-Palmolive, I discover that it's well below my threshold of 6% at 4%. When you look at what overvaluation did, even though operating results were good over historical periods of time, you can see that high valuations, here's the same PE ratio we have today, would have led to less than a 1% annualized rate of return for Colgate-Palmolive over the next 4 or 5 years. Valuation has a great impact on the return and the amount of risk you're taking to get whatever return you get. With my next example here, I'm looking at Clorox, and you see something very similar to what we saw before, an opportunity to buy it at a very low valuation, and as a result, generate a very attractive double-digit 13.4% rate of return by owning this stock over this period of time. But once again, we see where high valuations would have generated lower returns going forward. The current earnings yield on Clorox is only 4.5% currently, below the 6% threshold. With my next example, I'm going to take a look at AA-rated premium tech stock Cisco Systems, because I think this is really a great lesson in valuation. We all remember the tech bubble that occurred from the mid-90s or late 90s all the way through 2000 before the stocks corrected. But even after that immediate large correction, Cisco remained a very highly valued stock. And even though its earnings were continuing to grow and do well, investors that bought Cisco, even after it had corrected so dramatically, let's say in 2001, would have still suffered several years of negative rate of returns. This probably better than anything shows the impact of valuation. However, the company did start paying a dividend in 2011. I purchased it in December of 2012, and since that time I've averaged over 13.8%, strictly a function of buying it when it was undervalued. I also made a second purchase on Cisco in March of 2016. When I look at Cisco's current earnings yield, you see it's 7.5%, so this would be one of the few dividend growth stocks, although it's a new entry to the dividend growth category, that is actually attractively valued today. With my next example here, I'm going to look at the A- rated blue chip Consolidated Edison, the classic utility stock. And what first comes to my mind here is to notice how low the growth rate of utility stocks tend to be. Con Ed since 1998 has only averaged earnings growth of 1.8%. Both the blue line and the orange line, I actually take the blue line off, are approximately a 15 PE ratio, and you can see that the price correlates to that 15 PE ratio very closely. I did buy Consolidated Edison in June of 2013, and as a result of today's excessive overvaluation over this roughly 3-year period, slightly more, I've averaged over 12.8%, but I'm very concerned because the lack of growth in this stock, this type of overvaluation with such a low growth utility stock, is very troubling to me. When I look at the earnings yield on Consolidated Edison today, it's 4.9%. Utility stocks rarely generate any great capital appreciation, and this is strictly a function of overvaluation that's created the appreciation that this stock has generated since I've owned it. With my next example, I'm going to look at General Dynamics, because this is a very interesting case of understanding valuation and its importance. If you look at it long term, you can see that the price correlated very closely to a 15 PE ratio over all these years. Then, of course, the Great Recession came along and we had this large drop in stock price. But then we also had an administration in place that was kind of negative towards defense and defense spending. And so consequently, this stock languished at very low valuations for several years. I finally decided to purchase this stock on November 27th, 2012. And then, of course, I was lucky here, not smart, lucky, because since I've owned this stock, the appreciation potential has been enormous. I've averaged over 30%. And, you know, investors would be very, very happy with that kind of rate of return. And, of course, I am also. But I'm also very unhappy that the market has now driven this up to such a high valuation relative to its intrinsic value. The current earnings yield in this stock is 4.8%. And so now I have a dilemma. What do I do with my General Dynamics? I've continued to hold it thus far, but the valuations are clearly becoming almost ridiculously extended. Next, I'm going to take a look at the Coca-Cola Company, AA- rated, one of the most renowned dividend growth stocks out there. You can see the dividend record has been impeccable, and I'm back to using operating cash flows here. So I'm going to show PepsiCo next. And what you see is I had an opportunity to buy this at what I would call a sane multiple of operating cash flows, and as a result I've actually generated a double-digit return, 10% a year, since I've owned Coke. But I've become very concerned because if you look at the low rate of growth here, operating cash flow has grown at 3%. If I shorten this time frame, operating cash flow since 2011 has actually been a negative 2.3%. So this is one that I'm concerned with, not just on the fact that I consider the valuation high. The operating cash flow yield is 5.4%, which doesn't sound real bad, but what I'm really concerned about is what might be happening to the future growth of this company. And I'll do a similar analysis using the same metric with PepsiCo here. Again, utilizing operating cash flows and looking at Pepsi, a little bit different picture here from the standpoint of, I think there's a very high correlation between cash flow and stock price here. You again see clear periods of valuation and the impact, but you also see the relationship between growth and returns going forward. I was able to purchase this at a 14 price to cash flow. It's currently trading at a 17 price to cash flow, and I've generated an 11% rate of return. And although Pepsi doesn't look horrifically overvalued based on its relationship to cash flow, it's what's going to happen to the future cash flows that's concerning me right now with this particular company. Procter & Gamble is another one of these premier, highly recognized blue chip dividend growth stocks, AA- rated. As you can see, I was able to buy it at a very attractive 11 times cash flow. It's currently trading at a price to operating cash flow of double that, but I've averaged about 9% a year. But part of the reason why the price to cash flow is so high is because cash flows have been in a horrible downtrend through fiscal year June 16 to June 17. We haven't seen the final numbers yet, but again, I have a concern with the future growth of this. So the valuation looks high here only because there's concern what the operating cash flows might be doing going forward. I thought I'd share my experience with Illinois Tool Works for a couple of reasons. Again, I'm still looking at operating cash flows here, and you can see I was able to buy it when the valuation was only at 12 times operating cash flows. However, I actually sold out by April of 2014, averaged about 29% a year over this roughly 3-year period. But here's what I really want to show you. I was concerned because I was starting to see this dip in operating earnings here. From the time I sold it in April of 2014 through August of 2015, there was actually very little return. So this sale didn't look too bad for almost a year and a half, or close to a year and a half. However, subsequent to that, as you can see, the stock has gone straight up, where I left that kind of annualized rate of return on the table, but I never really complained about doubling my money. Nevertheless, I consider the current valuation of this stock extremely high, with an earnings yield below 6%. With my next example, I'm going to take a look at Microsoft, very similar to what we saw with Cisco. These extremely high valuations that created significant underperformance for many years, even though operating results were actually quite good. And then I had the opportunity to buy this stock in October of 2011 at a PE under 10. The PE has more than doubled since that time. I've averaged over 20% a year, but my real concern now is not just valuation, but also what the future growth potential. Earnings yield of about 4%, well below my threshold. But I think it really clearly illustrates how the market can get irrational at times. I've had a really great return, but now this is a stock that's clearly on my sell watch list, and I'm really concerned with what I'm going to replace it with going forward. But I'm about ready to sell Microsoft, even though I still like the company. Kimberly-Clark is another blue chip dividend paying stock that I was able to buy at an attractive valuation, and since that time it's become excessively overvalued. And what I again want to illustrate is that when you look at buying this stock at PEs that were close to what we currently have. Here's 22, a PE of 22, which is close to its current PE. If I'd have bought it then and held it to where I actually did buy it, I'd have averaged 2.5% a year. But by buying it at when the PE was 14 and holding it through here, I'm averaging over 13% a year. But again, Kimberly-Clark is clearly significantly overvalued relative to its earnings justified levels here. Medtronic is another good dividend growth stock. You can see the dividend record has been real good. That also tells several lessons about valuation. If we look at this period here, I'm going back to 2003, where the stock was perennially overvalued. It really flatlined for all these years and did nothing. I was able to buy it in April of 2010, and I might point out, from my original purchase, I suffered through losses for the next couple of years. Even though I was getting a pretty decent dividend, my capital appreciation was very weak. However, valuation becomes important, and since owning the stock, I've averaged over 11% because the earnings and dividends continue to grow, and now this stock has become overvalued relative to its intrinsic value, and you can see that very clearly here. With my next example, I'm looking at Altria Group, formerly known as Philip Morris, still has the symbol MO. You can see I was able to buy this at a 10.9, or call it an 11 PE ratio, in June of 2010. The rate of return since owning this stock has averaged over 24%, which is terrific. I do want you to notice how the stock stayed within a reasonable valuation level for all these years, and now it's become extended. And you currently have an earnings yield of under 5%, 4.4% if you'll notice. So here's another case of a stock that I believe is a great stock, A- rated. I don't necessarily like their product, and I really don't like their current valuation. With my final example, I'm going to take a look at Pfizer, and there's a couple of things that are really interesting here. If you look at Pfizer prior to the Great Recession, you actually see a stock that had tremendous growth, averaging almost 15% a year. However, you also see a stock that was during the irrational exuberant period, was really excessively overvalued, and there's probably no better example of how devastating overvaluation can be. These were obviously extreme PEs, but you would have held Pfizer for all this time here that I've marked, and you'd have lost an annualized return of 3.6%. But what I want you to notice is, as I move this forward, I want you to notice how the growth rate of Pfizer has really slowed down dramatically. This is no longer the growth story it was prior to the Great Recession. Nevertheless, I did buy Pfizer at a PE ratio of 11.9 in 2013. I've averaged a nice 9% rate of return, but I also want you to notice my $10,000 here would have grown to $12,580, which means I made a $2,580 profit. But this was for the income. I also received $1,800, almost $1,900 in dividends. And this is one example of a stock that's still reasonably valued in today's overvalued market. However, it's also an example, as I alluded to in the article, current earnings yield is 7.8%. But it's not just the current yield, it's also the growth potential. And it's really questionable how much this company is going to grow going forward. Anyway, these are 15 of the most prominent blue chip dividend growth stocks, and you can see the level of high valuation that exists out there today. So I caution the reader to be very cautious with your purchases today. Hold on to the great stocks, especially if you own them at great cost bases like I do with many of the examples I showed you here. But don't go to sleep either. This bull market has been running for a long time. It could run for a long time to come, but it could also end tomorrow. So as the old Latin phrase says, caveat emptor, buyer beware. This has been Chuck Carnevale saying thanks for listening.